$11 has so far held up in a pretty convincing way.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Thank you so much for joining us. Well, we'll take a look at the markets from Wednesday in just a moment. In the meantime, I want to remind you to make sure you like these videos, subscribe to the videos, and share these videos with others. It really does help with our algorithm as we continue to grow our audience. Well, today, my very special guest is Joe Camp of Comstock Investments. We're going to take a look at Wednesday's trade from his perspective, and there will not be any ag commodity trade on the 4th of July itself. It's a national holiday, so no markets are open. Joe, I wanted to clear up with you, though. There is some confusion. Will we have nighttime trade on the 4th of July that evening, or will we have to wait until a cold open on Friday?
That's right. Full session on Friday, but one that doesn't start until 8:30 Central. That means no overnight kicking off on Thursday like we sometimes have on holidays.
So everybody can enjoy the fireworks on the 4th of July well into the evening, and it won't matter. Let's take a look here at Wednesday's market action, the last trading day before the holiday, and it looked like corn was weaker. Soybeans were stronger. You had the wheat market under pressure. You had the cattle market doing pretty well. And then, of course, the hogs were just kind of mixed. They didn't do a whole lot. But I wondered what was driving everything. I understand you brought along a few supporting elements here that we can talk about.
Yeah, first, definitely that holiday type of influence with lighter volumes and some traders likely already off for the break. It can sometimes produce volatility, this transition, as we head back to work on Friday following the 4th. The bigger moves, maybe a switch of what we ultimately saw here leading in, which was that quiet type of just slight positioning, certainly a technical influence still. If we can say anything positive about grain futures and their performance so far this week, it's just that simply they didn't continue breaking lower following that bearish crop report day Friday. That coincides as well with some thought that we're testing these key support points. That's $4 for corn futures. That's $11 for new crop beans. That's the year's lows from earlier in March for wheat contracts. So all of that comes into play when the focus overall is still very much on weather. And those were the graphics that I wanted to bring up and just take a look at not only where we've come from, but what's still ahead in terms of the outlook.
Okay, what do you have on tap?
I've got the 30-day precipitation anomaly map that I want to share. And this is a reminder of what we've went through, of course, during this month of June that's just passed. You can see that big patch of green there in the overlapping areas of Iowa, Minnesota, South Dakota, northern Nebraska. And this is over the last month, but of course, a lot of that green came in a much shorter time frame. Considering the flooding issues that we're still working through, the impact not only on the human situation, but then these crops and potential there of crop logistics and railroads being out of service, bridges being washed out, high water levels, closing locks along the river system. All of that's something we've still got to deal with here going forward. It's something that we don't believe was reflected in any way on this last acreage report, but that can still show up, whether it's losing total planted acres, whether it's reducing the percentage of harvested acres as a percent of the total, or whether it's eventually these yields. But I point out first, the issue struggling with too much water. It's the flip of that. If you move south and into the Mid-South, these are areas of the country that are dealing with too little rain and temperatures that are higher than average.
Yeah, it's been hot, and I mean really hot and steamy in the South. Now, there's a new 30-day forecast map that came out. You have that for us, and it doesn't look like the South is going to catch much of a break from the heat.
No, this is the continued dichotomy between different regions of the U.S. and continuing to have this above normal type precipitation, leaning this graphic on the right for the month ahead, showing that same wet region continuing to have better chances than not for rainfall, whereas the opposite of that is true for elsewhere in the country, particularly notable here in the southern plains. Again, the drought outlook came out as well for not just July, but on into August and September, and you have these pockets of dryness expanding in the southern plains and further into this mid South region, also potentially up into parts of Illinois, Indiana, and Ohio. And that fits with what we hear from our customers on not only those dealing with the wet weather in the Northwest, but those from Kentucky talking about how hot and dry the toll it's taken on this crop, and farmers in southern Indiana dealing with the same. It's a very variable type of crop report that we're getting from farmers, which has something to say, I believe, down the road about these yields.
So, all in all, how do you think the crop is actually faring? And I'm talking about the corn crop. In the latest report, USDA said they expected that we would have 91.5 million acres, basically. And that was in that last report. That's quite a large acreage there. I just wondered if you think the anecdotal evidence that you've been hearing in the meantime supports a number like that, or if you still feel convinced that they're going to have to do some adjusting.
I think there's plenty of reason to expect that these supply numbers, the production numbers, can and will be adjusted lower in future reports. The question is always to what degree and how fast. But you look at the acreage numbers and start there. We had a relatively historically elevated acres left unplanted by the time these surveys took place, which was the feature of that Friday report. Almost 3.5 million acres of corn and over 12 million acres of soybeans. So those are acres that, one, could have been prevent planted and will be taken out of the total, or two, could have been replanted and replanted, eventually never to emerge, for one, in which case there'll be a loss in the harvested acreage. Or the other impact is that they were planted late and they should have a yield penalty docked on them for being put in past the second week of June in many cases. So all of that, is the sort of flip side of what we saw last week, is that even though, again, we have questions about the timing of these changes, it's not to rule out that they won't eventually occur.
With all the news circulating around the ag commodity trade and the big drop we've seen over the last month, and then, of course, with these USDA reports that came out a while back, it kind of has a look like maybe the commodity funds have thrown in the towel. What do you think?
Well, they're at a point where they've reamassed these almost record net short positions against the grains, and they're in this market defending those short bets, wanting to see something more convincing before they're going to start to take profit. Now, given that they are already at a spot where they're short by the equivalent of more than 1 billion bushels of corn. We can see in the traders positions chart the managed money in blue. Since this report was released this last week, there was a much greater push of additional selling that transpired through this crop report on Friday. So we are approaching again these record bearish positions, and wondering if there's much ammo now to add on to these positions. Now, whether or not they're ready to flip the other direction is another story, but it can be the case that we have diminishing selling pressure. And again, that fits with the technical influences so far, suggesting there are some points of support we're getting up against. And the other thing to point out for this trader positions chart would be where the managed money or the commercial traders are, rather. Those are the hedgers that are going to be selling futures when they buy grain from the farmers, and their position in red is about 1 billion bushels short of what it was at this time a year ago, because they haven't been buying that grain. The stocks report told us that the farmers maintain ownership of a relatively larger portion of the last crop, but that can be something that eventually helps the market, if not just briefly before the next crop is here to work with. But we can see the old crop maybe being a more friendly influence for a little while as these end users try to scramble for coverage of the remaining available old crop bushels.
So with the drop in prices here recently, has that changed the basis very much on the corn?
You see that generally you've had basis firming up in areas where they have to push for coverage, against farmers that are reluctant sellers following the recent price break. There are exceptions where basis is not as strong as it was a couple of weeks ago before these floodings. Again, knocked out railways like they did all the way spanning from Sioux Falls down to Sioux City, even over up towards St. Paul, Minnesota. And there are a lot of end users on those lines that would otherwise likely have the allowance to pay more, if not for the temporary outage of service. So we need to keep an eye on that. But just generally speaking, the firm basis is something that we still track as a supportive influence for the overall market, and it's something that can persist as an underpinning of this market until we get again closer to that next crop. We can see the corn basis map here as an example, where you get out west, a lot of Iowa, the yellow and green, those values are steady option type basis to even overs in places with this much corn on the balance sheet and still projected to have been carried over from the last crop. It's a wonder yet that basis is this historically strong in places. And it's got to say something, again, both about the reluctance of farmers to be selling, but also the margins for these end users and the overall robustness of demand.
Wow, that's quite a range. Something like $1.50 or something from the high to the low out in the plains. I mean, that's a big swing, something like that.
Yeah, you're absolutely seeing that or more, because of what we talk about as bids of $1.50 over in parts of the southern plains, where those feed users have to compete with not only the northern ethanol bid keeping that grain up there, but the southern export bid, where those feeders would have to see trains otherwise potentially move past them on their way to Mexico. So it's a big difference, even though in the north, where we're talking about unders, they're in many instances better by a good degree than what we'd normally expect for this time of the year.
So I just wondered, are you optimistic that maybe the soybeans have found a base for now?
$11 has so far held up in a pretty convincing way. You get under that point and you're going to wonder about technical ramifications, not having been down here since, say, the COVID year of 2020, before the ramp up of inflation. Generally speaking, we still have the prospects of new crop stocks drawing down from here on lower acres and or yield corrections. But the fundamental aspect is there too, and that would be that these lower prices have restored competitiveness in an even bigger way, not just for processing and renewable diesel. The story on one of the big stories on Wednesday here is that the soybean oil futures are rallying sharply. We've had a relatively strong recovery for crude oil, and that supports those processing margins. But I also want to bring up the export side of it. For as sluggish as that's been for soybeans, it can be the case that we don't have to get any weaker from here, and actually we could get some improvement in demand, like which we saw early this morning with a flash sale popping up for soybeans to an unknown buyer, maybe China.
Well, what about the wheat market? It seemed like maybe it had found a life preserver, but now it seems to be sinking once again.
Still that questioning about the seasonal trend and what we know to be a negative month of June, often transitioning into a more friendly month of July. I think the pause here is not that we have the tailwind, which I believe we do, from the majority of the winter wheat crop harvest having been now put behind us. But it's just this anticipation still of the crop production report coming up. That would be Friday next week, where the USDA can reconcile what we've been hearing in terms of mostly, quote unquote, better than expected yields coming both out of the southern plains and the hard red wheat crop and across soft red wheat growing country in the Midwest.
Well, let's talk about one of the more positive aspects of the ag commodity markets on Wednesday. That would be the cattle. They were up once again. That's quite a few plus signs that we have strung together here in the cattle market. So obviously that market still hasn't run out of gas, at least yet, right?
No, there's still so much optimism about the cash trade here. the July contract just converging towards the cash and expiring with a pretty good premium over the next up August contract. And most of the deferred contracts, there's a pretty good spread still up front. And so that strong basis helps. And what helps the strong basis and the firm cash bid, that's got to be these continued rising beef prices. That's what I brought to show here. The choice and select averages, the cutout that we monitor so closely. We're at such a critical juncture here, the 4th of July, not just for crops and how we think about the rest of the growing season for corn and soybeans, and oftentimes the seasonal inflection for prices. It holds true for the livestock as well. And particularly last year with beef, it did show up in terms of that spike last June occurring as you had all of the coverage bought up past the Memorial Day, Father's Day, 4th of July holidays. There was plenty of upside still to come for futures last year, but it can also be the case that we're almost entering a period where there can be a lull in demand, and that could eventually take the edge off. So I continue to approach the cattle market with what I'd call cautious bullishness, and with conversations about being ready to take advantage of the recent strength. It can be significant knowing that that spread was called to be a lot tighter here just recently, and something that would last maybe longer than it has, this impact of heavier cattle, of higher quality grades. What this says to me is that the demand is overpowering some of the more abundant quality type supplies that would go into the higher choice price. You have that, I think, speaking very well of the consumer position right now heading into the rest of the summer, that at these relatively higher prices for both of the cutout averages, you have this narrowing strength for the choice. So that's I think, a more positive sign here.
Well, talking about spreading, let's talk about the lean hog trade. I saw where the nearbys were stronger, the deferred contracts were weaker on Wednesday. What's that about?
There is some support from a rebounding cash trade. It's, the first time in a while we can talk about more material gains for direct hog averages out in the country. It's not necessarily the same thing that we can say for the pork cutout, which has faltered a little bit again lately. You have to look, though, at the overall price slide for hogs and think that even with slightly lower pork values, those packer margins are strong enough that they can support the cash trade continuing to firm up into the summer months, where we still do have projections for hog production to tighten before all is said and done. So, I think after such a long slide, you see the fundamentals responding, similar to what we talked about with grains. These lower prices can be the cure for lower prices when they start to reinvigorate demand, which we still have a window on as we just kick off the summer, really.
Joe, when we come back from the 4th of July break, we're only going to have one day of trading. That'll be on Friday. I just wondered if you've had a chance to do any research to see what the trends are when we come out of the Independence Day holiday in the markets. Does it mean a change in direction? Does it mean more volatility? I mean, we're going to be heading headlong into the month of July. And I just wondered what you're going to be watching out for signs in the market after we come back.
In one sense, I'm looking for a contra-seasonal type of turnaround that's possible, given that we did not have that large run-up in June that historically it has been the case for corn and soybean futures. So instead of a market that really significantly ever priced in the concerns that all the time go with the planting season and early season weather risk, you have now the potential that, okay, these issues are still lingering past the 4th of July. There has to be better recognition of this, not only in the market, but eventually in these USDA reports. So again, I go back to the thought that even if they're slow to recognize and to realize what's out there or not, in this case, the damage done during the planting season, during the latest flooding, Because of reverse that in areas hot and dry conditions and the high variability that is not the consistency that it takes to make record yields, that's the potential recipe for a different than usual type of action leading into July and August, where we could actually have the potential to see prices strengthen into the harvest instead of falter lower, as is often the case.
Is there a seasonality to the fund trading patterns after an Independence Day holiday?
There hasn't been a clear a position for funds, except for that they know the seasonal trend is lower. So in times when they are heavily long heading into the first part of the summer, there has been that tendency for them to cut those positions. But it's the reverse, or potentially the reverse, when we have a year like this, when they're so short and a lot more bearish than usual at the end of spring. Now you would wonder if the flip side of it is, as we talked about, the potential short covering aspect of it in weeks ahead.
Well, now that we're into the second half of the year, isn't that when China would normally start coming back into the market to buy some U.S. soybeans?
They would start to come back in for new crop soybeans. It's also, though, the time of the year when they may be canceling those old crop commitments. That is something that's maybe less likely than it has been in years past. Less of a risk for Chinese cancellations because, in part, we don't have those same outstanding sales on the books to China. We also don't have that big start on new crop interest at the moment, but it is something that we could start to anticipate going forward, especially given that there's this discount in the futures market down to the new crop contracts, and because the overall recent price slide has made us more competitive against particularly South American export offers.
All right. Well, great information once again, Joe, and thank you for taking some time to talk with us. I always look forward to that. Joe Camp with us from Comstock Investments. Joe, I hope you and yours have a safe and happy holiday out there. And of course, just a reminder, we will be back Friday for one day of trade before the weekend. And I hope you and yours out there all have a safe and happy 4th of July Independence Day celebration. Stay safe. We appreciate you joining us here for today, and we'll see you after the break. For producer Brianne Hendrickson, I'm Marlin Bohling, and we'll catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.